I want to talk about the losers. There's two stocks in our portfolio that have lost money so far, and I want to focus on them, Raytheon and Intel. This is the Not Even Wrong podcast. It's August 24th, 2020. This is Crindelco. Today, the fund is down 5%, and the market was up around 1%. For the year, we're up 189%, and the market is up 6%. We're outperforming by 183%. So that means if on January 1st you put $100 in Orange Capital Partners and $100 in the S&P 500, today you would have $289 with us and $106 with the S&P. We've made money with Tesla, we've made money with our CRISPR index, we've made money with Microsoft. We have lost money with two of our call option positions. One is Intel and the other Raytheon, and today I want to talk about them, our thinking, the reasons why we lost money, and the way we think this is going to evolve going forward. Let's start with Intel. So about a month and a half ago, we bought the 2020 90 strike calls on Intel. So these are long-term calls on Intel, and there's a couple of reasons why we bought those calls. I think the main reason is leverage. One way to get leverage in your fund is to buy options, which gives you what in the fund business we call convexity, and it also limits your loss. So what that means in plain English is you put a certain amount of money on the table, the premium that you pay for the options, and that's it. You can't lose any more than that. And when the stock doesn't do anything, you just lose that premium. If the stock goes up to the strike and above the strike, you start making a disproportional amount of money. That's the convexity from the curve that your P&L starts looking like. So, for example, if the stock went to 120 by the time of the expiration, we would make around 30% in our portfolio. If the stock went to 150, we would start making 50, 60%, even more. I don't know the exact numbers, but the amounts start really accumulating very fast. Versus if the stock went to a 90, we make nothing. If the stock went to 80, we make nothing. If the stock went to 95, we make a little bit, etc. So there is this curve that starts exponentially rising. That's the convexity, and this is what you get with call options. Now, why did we choose call options? Other than the leverage, it's also the fact that we believe Intel is a dramatically misunderstood company. Here's why. Intel is the leader in certain chip technology, design, and manufacturing areas. Not everything, but in certain areas, the ones where you do sort of the general purpose computing, Intel is the leader. The reason the stock is not doing well is because that leadership is under threat. It's under threat by several players. One is AMD, which is able to gain market share against Intel. The other is NVIDIA, which is a leader in GPUs, graphic processing units, but also has been able to enter markets where Intel was very strong and gain market share from Intel. And then there is also a lot of other startups and smaller companies, even incumbents like Microsoft and Google, who are making their own chip, Tesla, for example. So there are threats from all over the place. So what happened to Intel in the last couple of months is that on top of all these threats, the company has announced a delay in manufacturing their 10 nanometer and 7 nanometer technologies. I'm actually, to be precise, their 10 nanometer is now being produced. That was delayed, and the 7 nanometer technologies has been delayed, so it will take a bit longer. And given that the other companies, like for example AMD, are using external foundries such as Taiwan Semiconductor, which are already at processing nodes ahead of Intel, that means that there is a chance theoretically that Intel's chips will be inferior to, let's say, chips like AMD or NVIDIA and etc. Now, having said all of that, this is all theoretical. This is the market speculating. And I would say the way we see this is there's a lot of grudge against Intel because Intel used to be a monopoly for decades. So there's this joy in the market that finally this monopoly is broken, and this is just a typical human Silicon Valley style reaction. Nothing wrong with that. The question, of course, from an investor perspective is it real? Is Intel really under threat? Are they really losing market share, or is this just a myth? And the reality is, yes, they're losing some market share, but in the words of Intel CEO Bob Swan, the market share they're losing in some narrow markets is being compensated by the size and the growth of all the other markets where Intel is in the business. And they name it data-centric businesses, which in plain English just means all the stuff which is happening at the periphery all the way into the data center, and all the data which has to be collected and processed. This market is growing by leaps and bounds and offering tremendous opportunity for everybody to grow. So our conclusion at Orange Capital Partners is that Intel will, at the worst, just lose market share in certain narrow markets, such as, for example, servers in the data center, maybe laptops, things like that, but gain overall, grow with the market. On top of that, there is also the remote work theme that we've highlighted several times on this podcast, which is we compare that with the Y2K problem before the millennium, which is basically a massive need for investments to solve a particular IT problem. In today's case, it's the remote work, remote pay, remote everything type problems, which in a nutshell can be compressed into massive computing problems in a more detailed way. These are problems of security, problems of access, problems of things like payments and fraud. So there is a tremendous amount of need for computing power and computing solutions. And Intel is a leader in this market. We believe will not just grow with the market, but still be the number one place to go for solutions. And then the other players will be able to grab market share in adjacent markets or more like experimental type markets. A good example is NVIDIA, that they're growing in machine learning type applications very strong, but those are very specific machine learning type applications and they're adjacent to Intel. So what that means is you have a need for both companies' products and solutions to grow your machine learning expertise within the data center or within your own premises. So in a nutshell, we think that given where the Intel stock is trading right now, the free cash flow yield of Intel is in the 5, 6, 7% range, depending on what kind of free cash flow you're expecting. Given that we have zero interest rates, given that we have massive valuations in stocks like Apple, Amazon, NVIDIA, AMD, etc., the discrepancy between those stocks and Intel is just massive. It doesn't explain enough to say, yeah, they're just under threat and therefore the stock is underperforming. There is, even if you take that into account, even if you take the threat, even if you take the risk of losing market share, even if you take all these things into account, Intel could easily double, if not more, and still be relatively cheap. And this is our call. And that's why we bought the calls. And we are, unfortunately, so far down about 2.2%. That means we lost 2.2% to the portfolio with this Intel position. We're holding on to the calls, and we expect in the next 6 to 8 months a reversal of this trend. One good sign is that Intel has announced a stock buyback, which is relatively unusual for Intel. Intel actually doesn't do stock buybacks. They pay dividends, but they don't do stock buybacks, and they did announce a stock buyback last week based on the fact that they themselves said our stock is massively undervalued. The other situation we have in the portfolio that lost us about 1% so far is Raytheon. We bought Raytheon right sort of after the first wave of Corona hit and was digested. And Raytheon is a company, it's a mix of two companies, basically a commercial airspace company and a defense company. The defense side of Raytheon is the crown jewel of the company. It's basically the missiles that are guided, that can be used to hit targets from remote areas and be very precise in the way they hit targets. So when you hear Trump bragging about the fact that he can take out terrorists or leaders, even if he wants very high-ranking leaders, with very precise missiles and not jeopardize any human lives. He's talking about Raytheon. Raytheon is a company that has grown up sort of in the pre-World War II area, particularly with developing radar. As the name says, they're very good with rays, X-rays and things like that. And that's what they're still using to use remote guided, very intelligent missiles. So on that front, Raytheon is very, very powerful, and that business is, in this day and age, still doing extremely well. However, the commercial airlines side is suffering because there is no travel. There's just no demand. So it starts with companies like Boeing and Airbus scaling down production, airlines buying less airplanes, and therefore there's less need for services such as Pratt & Whitney, which is an engine company, or Collins, which is a sort of cockpit electronics company. Those are phenomenal companies, and they are very good at what they do, but if there's less demand in the end market, no matter how good you are, you will suffer. And unfortunately, the second wave of COVID hit these stocks very hard, because the expectation was that travel will come back, and it's not coming back, particularly international, intercontinental travel, business travel. All these things that used to be normal in the old days now with COVID are unfortunately not that normal anymore. The stock is, since we bought the calls, we bought the 2020 100 calls, and the stock is in the mid-60s now, so there's still quite a ways to go. Very similar to Intel, we believe that the valuation and the cash flow yield of the stock, even under assumptions that are very stringent in terms of, let's say, them losing market share and losing earnings potential, even under stringent conservative assumptions, given that we have zero nominal rates and negative real rates, we believe that a free cash flow yield of 3%, for example, would be pretty decent for a stock like that. And then you can justify a stock in the 120 to 140 range. And given the convexity that we have with our calls, that would produce quite a bit of P&L for us. So those are the two situations and our thoughts. When you, as I stated many times, the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So those are good examples of not just us going into situations that are controversial, but also using instruments such as options to get more leverage and reduce the risk and the volatility in the portfolio. And we are unfortunately a little bit suffering right now because the market misconception is, in our view, very extreme. There's also a strong demand for high growth stocks, and for some reason, money and capital is not flowing into stocks such as Raytheon or Intel. We believe that that will reverse, particularly when these companies start showing some substantial numbers. Thank you.